Around 90% of new car purchases in the UK are bought on finance. But if you're at the point where you're investing or you're thinking about investing, should you be when you have this kind of debt? This decision is very different to just a few years ago. We had a decade of ultra low interest rates. You could get a car loan around 3 or 4%. Now they're up towards 7 to 9%. Low interest rates are also very good for the stock market. It allows companies to borrow at a low interest rate and it encourages them to grow even further. So in the current environment, is it still viable to invest while you have a car loan or any other debt for that matter? When comparing interest rates on debt to stock market returns, it's very important to take into account time horizon. So if we look at average returns for the stock market, it's around 9 to 10%. But it's very rarely that average. There's wild swings, anywhere from -30 up to +40 or 50%. And if you look back in history, if you take any 5-year period, there's always been a positive return. Obviously, there's no guarantee of that in the future. But what that does tell us is that if you're looking to invest within 5 years, there's no guarantee that you're going to get a positive return. And actually, you're taking on more risk of getting a return above the interest rate you're going to get on your debt. However, if you have a longer time horizon that's at least 5 years, then you can be more confident of a positive return that's going to be closer to that average return. And then in that case, it's likely that it could be higher than the interest rate that you have on a loan. But of course, it's not that simple. When you're thinking about paying off a loan or paying any debt for that matter, that is a guaranteed return on your money. So if you have a car loan that is 7% interest rate, any money that you can overpay to reduce that loan, as long as there's no extra fees to overpay, that's like getting 7% of your money. Bearing in mind, if you put money into a bank account now, you'll be lucky to get around 4%. That's the risk-free rate. So if you can get 7% on your money simply just by paying off more debt, that's a great return on your money. That's essentially risk-free and it's guaranteed. The other side of that is that once you've paid off that debt, you can't get that money back. So say you want to pay an extra couple of £100 off your car loan this month. Once you've paid it, within a few weeks or a few months later down the line, you can't then go, oh, I need to take that back because of an emergency or some other matter that comes up. Where of course, if you've put that money into the stock market, it might not be ideal taking it out, but at least you have some form of flexibility that you still have access to that money. So when looking to pay down debt quicker, make sure you've got your emergency fund set up. So around 3 to 6 months would be ideal, but at least 1 month. And that means that you can cover any short-term expenses. You don't need to sell any investments and you can afford to pay off that debt knowing that you don't need that money. There's also a massive psychological element at play here. We can look at all of the numbers on paper, we can look back at history, but actually there's a really important point about how it makes you feel. And if you get anxiety around having that debt, then actually paying off that debt is going to make you feel better. Because similar to paying off your mortgage or any other debt that you have, if you can get to a point where you're debt free, so you own that asset without having to have any payments on it, that could make you feel much better. And I would actually say that that's worth a lot more than just getting an extra couple of percent potentially investing into the stock market than just paying off that loan. However, especially with something like a car loan, if you pay down that loan quicker and then you get to the point where you own that vehicle outright, how does that make you feel? So are you going to keep that vehicle for another few years? Or are you then going to think, oh, well, I own this now. I could sell this. I could then get a new car. I could take out a new loan and I'll just repeat the process. Because if that's the case, then you're always going to have that debt. So actually that psychological element is then different for you because it's not about getting rid of the debt. That then more is a decision of what we said before about the guaranteed return versus the potential return in the stock market. Of course, you can have a balanced approach as well. And you can also look at stock market cycles. So this is all about thinking about where the stock market is. If we've just had a massive crash, then that could be a more advantageous time to get into the stock market. However, if the stock market has been on a bit of a rally and it's had multiple years of really positive returns, exactly like we've just had, so 2023, 2024 were massively positive years for the stock market. It was being dragged by the Magnificent Seven. Those tech stocks, which are a heavy part of the stock market, were dragging the performance up. And there was a sense that the stock market was getting slightly overinflated, AI stocks specifically, and people were drawing comparisons to the dot-com bubble. So before all this tariff chaos and the correction in the stock market, you could have made a decision that, okay, we've had 2 really positive years, both plus 20%. Okay, I'm going to pay back more of this debt because that's a guaranteed return on my money. I'm going to get 7% essentially on cash. Yes, the stock market might continue going up. You're never going to call the top. But when it does come down, and like we've just seen in the last few months, it's come down 10, 15, even 20%. Okay, now might be the time to start investing a little bit more into the stock market. Obviously, that's having a little bit more of an active approach. So it depends how involved you want to be. and it's not always going to be obvious. Of course, in hindsight, looking back, you're just gone, oh yeah, well, I would pay off debt here, I would invest in the stock market here. And while it's all going on, it can be very hard to make those decisions. It's so easy to look back at previous crashes and just go, oh, well, I would have just invested there. But while you go through that crash, it's very hard to have that mindset because there's so much negativity around. The media's going crazy and just that negative rhetoric that's around. So a lot of it depends on whether you can see through that and still have that conviction to invest into that stock market long term at a price that you know has been discounted. I would also look at your investing setup as a whole. So if you've maxed out your ISA, for example, so in the UK, you can put £20,000 a year into an ISA and any returns you get on that money are going to be tax-free. If you have reasonable pension contributions as well, then your only other option to invest further into the stock market is to use a general investment account. And then of course, any returns you do get on that account are going to be subject to tax. So that then does reduce slightly the amount of return you get in the stock market. So if you're in that position, then it would be more worthwhile paying that debt down because you get that guaranteed return on your money, and any returns in the stock market are going to be slightly watered down because you're going to have to pay tax on it. And talking about pensions, that could be a way to supercharge those results in the stock market because any pension contributions that you make will be subject to either 20, 40 or 45% tax relief depending on how much you earn. So not only will you get the returns in the stock market, but because you get such good tax relief, you just can't be that anywhere else. And that's one way that you can guarantee that you'll get a better return than simply just paying off that debt. Again, that obviously depends on where you are in your investment journey. Obviously, if you're very young, that can be great for the long term, but obviously you're not going to be able to access that money for a long period of time until you retire. If you're coming up to retirement, then that could be great because you know you can access the money very soon. But of course, you've got to take into account you do have a shorter time horizon. Ultimately, this is going to come down to your risk tolerance and your time horizon and your unique setup. Everyone's going to be different in that sense. But remember, you can have a balanced approach. It doesn't need to be one or the other. It doesn't need to be, I need to either invest or I need to pay down debt. You can have a balanced approach. So if you've got £200 extra that you can invest per month, maybe you just split that in two. You do 100 of each. And of course, you need to look at, are there any extra fees of paying back that car loan early? Is it simply a case of being able to pay more, or is it a little bit more nuanced than that? So it's important to look into the details of that. I'll leave it there. I hope you found that useful. Drop it a like if you enjoyed it. Let me know your thoughts in the comments. Subscribe if you're new, and I will catch you in the next one.